Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are you're watching this video because you got an email from me by being on my free email list telling you it's out. If you're not on the email list, click the link associated with it to get on it. And if you're just randomly watching this video on YouTube, click the subscribe button on the YouTube video and then click the bell so YouTube will tell you when the next video is up. Because what I'm doing in this video is the first in what's going to be a series of videos about investing in a time of turmoil. I'm doing this in November of 2020, and we've seen the stock market crash essentially in March. It fell over 33% and then had a massive rebound rally. And as we're going into the end of the year, the environment is still positive. But what does this drop represent? And what can we look forward to going forward next year and the years to follow? One thing that's going on in the markets is interest rates were dropped to zero by the Federal Reserve. And this causes a problem for anyone who wants to diversify in the markets because bonds now yield absolutely nothing. So that's a big challenge, and that's something I'll be talking about in a future video. We're going to tackle different angles of the market environment and what the implications are for it going forward, how to navigate things throughout this entire series. But in this video, I want to step back and just look at what really was the defining feature of the stock market action this year in 2020, because it has huge implications going forward, and it's something people really aren't thinking about. I mean, let's just drop things down to the very simplest factors. So let me share my screen with you. And what you're looking at here is a chart of the S&P 500 going back all the way to 2001. And you can see in 2009, you know, the market fell actually down to, I think it was 666, and it's gone up to close to 3,600 this Labor Day. But in March, it fell and touched essentially 2,200, a very vicious decline. And you can see it's had its ups and downs, but nothing like that one. And what that represents is huge stock market volatility this year, huge swings down and up. That has been the defining feature of this year, and that's what we need to think about. So if we look at this chart, there's two things below the S&P 500 chart. The first is the VIX, the Volatility Index. It's often talked about on CNBC and on Fox Business and in the financial media in general. And you need to know what it is if you don't already. It measures the premium that options traders are paying for volatility. When you buy an option, you're paying a premium for volatility and time out in the future. How long is the option gonna, when does it expire? And those values can change. Time drops in value as you get closer to that endpoint, but volatility can move up and down. And typically when there is a big panic or drop in the market, that volatility premium will spike up because people are willing to pay higher and higher prices, because when the market does decline, it tends to fall faster than when it goes up. So volatility does increase, but it can get to the point where the people are panicking so much in a scramble to hedge that they drive the premiums sky high. And that's what one reason people call the VIX, the so-called fear index, because when there's big fear in the market, a selling panic, the premiums can jump. Historically, when it gets above 30, that's a sign that there is panic in the markets. But this March, it touched above 80 and even surpassed the levels of 2009. In 2018, we saw strange temporary spike in the VIX up to 40, in which there was a panic actually in exchange traded funds that trade the VIX. That's a discussion for another time. But what's important for you to understand is that the VIX is seen as a psychological indicator because it's measuring not actually the real volatility, but what people are paying for volatility. So it's sort of a perception of fear. And there's times when the VIX can get extremely low, in fact, too low, where people are paying too little because there's like absolutely no fear out there. And those periods of time can actually go on for even over a year. So there was a time in 2019 where the premiums got around 10. That's a super low level because in any given year, the stock market volatility typically is in a 15% range, not 40%, not a 30%, not a 10% range. So when it's below, when it's 10, that's like super low. And the indicator on the bottom is actually measuring real volatility over a 250-day period. And you can see historically, actually right now, over the past 250 days, the average volatility is just 15.86%. And that's an historical trend. You know, typically this real volatility doesn't get above 25 or below 20. And it did this year. It hit 25. It actually started this year above 25 because the market was shooting up into the end of the year. There was high volatility going into the year, but no one was really paying up for that in the options market because they weren't worried or scared. When things are going up, people aren't scared. It's on the declines where the VIX tends to shoot up when the fear in the market is really there. But when there's high volatility on the upside, no one really cares. And so the premiums don't go up. In fact, that actually happened this year too. After the March bottom in the market shot up with extremely high volatility because it went up 70% basically from the low into Labor Day, a massive move to the upside in a short amount of time. And while that was going on, the VIX was trending down from the high of March. So that's something to consider. But the thing about this chart is the bottom is the real volatility in the market over a 250-day average period. And the top, the VIX is the premium that people are paying. So you can see the discrepancy in this. So for example, in 2008, that 250-day average of volatility got close to 50%, because the market fell, crashed, but the VIX premium got over 80. So the premium in the options market got bigger than the real volatility in the market, just as it did this March. The market fell over 33%, but the VIX got above 80. So when the market was down already 33%, there are people willing to buy options priced in for another 80% decline, which is absolute, pure total panic. And obviously it didn't happen, right? So this has huge implications though. So look at the periods in 2017, the VIX was below 10 for the longest amount of time. That was a year of extremely low volatility, and it led to what some called a flash crash in February 2018, and the VIX had a big spike. There's a giant spike of volatility over a 3-week period. You could say the same thing happened in 2019. Low volatility in the summer of 2019, leading to a high volatility breakout, and then a crash this March. A similar type thing happened in 2013 and 2014. Extremely low volatility led to a 20% decline in the stock market that began in July 2015, ended in the first quarter of 2016, from 2005, 2006, early 2007. Also a period of extremely low volatility that led to high volatility. So what's the lesson? Very simple. Periods of low volatility in the markets eventually lead to periods of high volatility, and periods of high volatility will end up leading to periods of low volatility. It's a cycle. And this year has been marked with extreme high volatility, not only in the VIX, but in the reality of that rate of change indicator of the real volatility below on the bottom of this chart. You know, the swing up above 25, then down back to negative 25, then back up. That's high extreme volatility where 0 is the mean. So what this means, my takeaway from this is that we're actually going to enter a period probably that started probably around Labor Day, but we're going to enter a period that could last 6 months, probably longer, and you'll see why in a few minutes, of a return to low volatility, where the market will trade in a low, will end up reaching a point where that VIX will continue to decline over the next 6, maybe even 12 months, back down to the teens. It could even get down to 10. That would be tough to do, but it could get there if it takes a year. But we're still above 23 at the moment, you know, and that's higher than 15%. So we're at least going to get down to 15, probably towards 10. And that takes time to get there. It's going to take months from even now to get to that point. Probably take to the spring to get to that point. And that process of low volatility could easily continue into the fall next year. It's a chance it could even go beyond that. So what does this mean? Well, people are kind of gotten used to, so there's people out there scared of a stock market crash because the economic situation is still bad. There's still high unemployment. There's still, you know, shutdowns in the economy. The virus situation is still out there, looking to get worse over the next couple of months, but that'll peak out and hopefully completely even go away starting in March or April. This will peak out, but people are scared. At the same time, there's people extremely bullish on the stock market who think that what happened from March to Labor Day is how the market should trade. Many people got into the market for the very first time during that period, and that's not a normal market. You know, the market does not normally go up that fast, and it no longer is. And some are still looking for, you know, they're looking at very short-term action, thinking an update in the market represents the start of a massive rally, you know, 30 or 50% again. But no, in reality, what's likely to happen is establishment of a sideways market pattern, some sort of trading range for 6 to 12 months from now, or that will go on like that. Doesn't mean we can't go up a little bit more. We can, but I don't think we're going to see substantial rallies in the market anymore. That means it's going to be tough to make a lot of money buying the S&P 500 indexes or other the QQQs or so forth, and best to stick to sectors that have trading patterns of their own, that aren't trading with our averages, sectors doing the same thing, in stocks doing the same thing too. Look, there's sectors in bull markets of their own, individual stocks the same way. That's the place to make money, but there's no reason to fear a stock market crash anytime soon. Yes, we could have another decline in the future, but it's not going to happen at least in the next 6 months, probably even longer than that. So that's the setup. And the reason for it is that this year's been marked by extreme volatility. We're going to return to the mean of lowering volatility over time. And another indicator I like to use that, well, let me point this out to you. Here's the rate of change indicator again on the bottom, this time using a 90-day measurement. And you can see how it fell towards 30 and then up to 40. That's the biggest decline and swing back up in that indicator's history. Again, a suggestion that we're going to revert to the mean, and we're starting to do that, but the mean is below 10 and above negative 10. You know, typically in the average year, the market does not go down more than 10% or up more than 10%. So I think that's probably what we're going to see, a trading range defined in a swing of that sort for 6 to 12 months. Now, another thing to point out is this indicator on the top, the RSI indicator. It's a momentum overbought, oversold indicator. It reached an extreme overbought level on Labor Day, and the stock market then stalled out, fell 10%, and then it started what now appears to be a range-bound pattern. So I think it probably already began around Labor Day. We made a minor new high, but it's not a meaningful big rally now. Yeah, it could go up to 3,700 by New Year's or something, but maybe not. Maybe it goes back down to 3,400, then bounces back up to where it is. I don't know. I'm not trying to predict the short-term swings in the market. It's the big picture that I want to focus on and think about now, and that is range-bound trading in the markets. We've been in that environment really since Labor Day. I think it's only going to continue now for probably 6 to 12 months. And let me show you another reason why I think that. So one of my favorite indicators is the Bollinger Bands. I often use 15 or 20-day Bollinger Bands, but for the long-term trend, I use 200-day Bollinger Bands. Those are the two peak bands on the top and the bottom of the price chart here. And the indicator on the bottom, BB width, is measuring the distance between the two bands. This is another indicator that measures real volatility in the market. This time I'm using 200-day average prices. When the bands get farther apart, there's more volatility. When they come close together, there is less. And using the 200-day bands enables us to measure this in a very long-term time frame. You can see in 2009, the width indicator got above 80. That was also a manic historic peak, and it coincided with the March bear market bottom. The market fell over 50% by then. I think it got down to 50% in October 2008 from the 2007 peak. But anyway, when it's the same rule, when there's massive volatility in the market, things tend to come back to the mean slowly over time. When there's very low volatility, then volatility will eventually appear. And what we're seeing is the 200-day Bollinger Band width right below 40, which historically is a very high level. Take out that move above 80, and you can see that 40 is a historically high level, and the last seen in late 2002, when that bear market from 2000 to 2003 or 2 came to an end. You had a triple bottoming process from July 2002 to the first quarter of 2003, in which this 200-day Bollinger Band width indicator got above 40. When volatility hits an extreme, it's often a turning point in a market long-term trend, and we're at 40. So that doesn't mean we're tipping into a bear market right now. We're about to see a significant decline immediately. I do not think so, as I'm repeating, but what it does mean is expect the Bollinger Band width indicator to go back below 20. That's a move that would take this indicator months to accomplish, probably at least 6 months, maybe even longer. This indicator moves very, very slow. So again, this creates an outlook in which the bear argument is very, the argument to say that we're starting a bear market now is very difficult to make. The risk of an immediate substantial decline in the stock market is very low, despite all the bad news I could go on and on hours talking about. It's not in the stock market itself. The stock market, in some senses, has completely detached from reality in terms of valuation. We have companies that earnings have shrunk all year, and since March, the stock market has gone up. There's stocks that have 20% of American companies are now zombie companies, meaning that they are not able to use their revenue to invest in themselves, to increase production, or take advantage of new opportunities. Instead, they're using anything they can get to pay off their debts. They have such massive debt burdens. And then that's a defining feature now of the American economy. And it's why interest rates are zero, because they have to be in order for the U.S. government to finance its debts. The rates cannot go up but a little bit from here without eventual trouble coming. So all this means politics you know, the real economy, real news, none of it matters for the stock market. All that matters is this trend of high volatility this year, reverting to low volatility over the next 6 to 12 months. After that, that'll be a whole new story. But this is the environment we're in, and this will set the stage for my next video, in which we can use this building block to think more about the implications of all this in the market and what it all means. So for the next video, subscribe to my email list, click the subscribe button, and look at the notes for this video, and you also see a link to a page where I'm posting all the entire series all together on a page of my website. So click that and you can find all the videos at once. This is gonna be a great series, probably put out one a week for a while. There's a lot of stuff to talk about, and they're all gonna work off together.